Welcome to Dismal Science, and welcome to what I think is one of the most common misconceptions out there when it comes to economics. And that's how people measure currency strength. Because most people, when they think about how strong a currency is, they're using one number to mean three completely different things. And that's where it all goes wrong. So in this video, I'm going to break down all three of them, show you why conflating them leads to wrong conclusions, and by the end, you'll have a much cleaner framework for thinking about this. You've seen this board at an airport, at a bank, or on your phone. A list of currencies, a list of numbers next to them. And most people look at this and think, okay, bigger number means strong currency. That's the assumption we're going to take apart today. There are multiple ways to assess a currency's strength. You've got three lenses here. First, you could just look at the nominal value per unit. How many euros do you get for a dollar? That's the exchange rate most people think of. Second, you could ask, how much can I actually buy with that unit in terms of real goods and services? That's purchasing power. And then third, you could zoom out and look at it from a global perspective. How much does the world structurally depend on this currency? Is it actually used? And I'm going to take a look at all three because they tell very different stories. So let's start with the first one, the exchange rate. And I want to make something very clear right off the bat. The exchange rate is just the price. When you see that the euro trades at 1.16 against the dollar, all that means is I need $1.16 to buy 1 euro today. That's it. It's a market price set by supply and demand. A high nominal exchange rate just means unit is large. It says absolutely nothing about economic strength. To give you an example, one Kuwaiti dinar is 3.26 US dollars. Meanwhile, one Japanese yen is 0.006 US dollars. Does that mean the Kuwaiti dinar is a stronger, more important currency than the Japanese yen? Absolutely not. Not even close. But we'll come back to the why in just a moment. Let's think of a hypothetical scenario to illustrate that the unit size is arbitrary. Let's say the US decides to redominate the currency, so 100 old US dollars turn into 1 new US dollar. Overnight, the Euro USD exchange rate would mechanically jump from around 1.16 to around 0.0116. Does that mean America is great again and that the American economy just became 100 times stronger? No. Nothing changed. The unit got smaller. That's all. This has happened multiple times throughout history. For example, Germany in 1923, when the Papiermark turned into the Rentenmark, or Zimbabwe in 2009. 100 billion marks. That's what it says on the note. And yet, you barely could buy half a loaf of bread with it during the peak of hyperinflation in November of 1923. That's why people used it for heating, because it was cheaper than buying firewood. The unit size is purely arbitrary. What matters is what's behind it. Okay, so I have spent quite some time explaining why the nominal rate is just a price. Well, then what do we actually want to look at? And that brings us to the second lens, the real exchange rate. And the formula is quite simple and quite intuitive. If everything in your country gets more expensive, your currency buys less, in real terms. Even if the exchange rate number stays the same or even goes up. If the euro rises 10% against the dollar, but the Eurozone inflation is also 10% higher than US inflation, in real terms it evens out. European goods overall cost the same to American buyers as before. Let's imagine we're an American wanting to buy an Italian car priced at 50,000 euros. So in our current scenario, the exchange rate is 1.10, the car price is 50,000 euros, the inflation is the same, and the cost to an American is 55,000 US dollars. So on paper, the car just got 10% more expensive for you. But now let's look at it if we also have inflation. So now the exchange rate is at 1.21, the car price is at 55,000 euros, and Now the inflation rate is at 10% as discussed, but the cost to an American is still the same at 55,000 US dollars. So the change in the exchange rate and inflation cancel each other out. And that's what the real exchange rate captures. And for trade, for competitiveness, for whether a country's exports are getting cheaper or more expensive for the rest of the world, this is a number that actually matters. Let's take a small detour. Now, the concept of purchasing power parity, or PPP, takes that same idea and applies it globally. The question it tries to answer: if exchange rates were set purely by what a unit of currency can actually buy you, what would they look like? And a good illustration of this is a Big Mac index. The Economist started publishing it in 1986. The idea is quite simple. A Big Mac is more or less the same product in every country. Same ingredients, same process. So if a Big Mac costs $5.5 in the US and the equivalent of $8.17 in Switzerland, the Swiss franc is overvalued by about 44% on a PPP basis, as you can get the same product cheaper in the US, and vice versa for India or Brazil. Let's talk about the third lens, broad external strengths. And this is where it gets really interesting. Look at this chart, the share of global trade invoiced in each major currency. The dollar is at around 54%, so the euro is second at about 28%. Everyone else is far behind. Meanwhile, the United States accounts for roughly 13% of global trade, but 54% of global trade is invoiced in dollars. And that gap is structural power, explaining why the US dollar became so dominant in world trade deserves a video of its own. But to keep it short, it stems from Bretton Woods in 1944, from the petrodollar arrangement where oil is priced in dollars, and from the depths of the US Treasury market. On top of that, we have a simple network effect. Everyone invoices in dollars because everybody else also does. So 54% of world trade is in dollars. Okay, so what? Why should you care? Let me give you a concrete example. Brazil sells soybeans to China and wants to be paid in dollars. Why do they want to be paid in dollars? It's not a legal tender in Brazil. That's true. But every major commodity on the global market is being traded in dollars. So if Brazil wants to later on buy metals, food, energy, whatever, they need a stash of dollars to do so. So when Brazil exports soybeans, they take dollars because dollars are what you need to participate in the global economy. Since you need US dollars to engage in international trade, every central bank is constantly accumulating US dollars. And what do you do with dollars you're holding in reserve? You buy US Treasury bonds, because that's the safest, most liquid dollar asset on Earth. So now you have every major central bank on the planet as a permanent structural buyer of American government debt. So when everyone is buying your bonds, your borrowing costs go down. The US government borrows more cheaply than any other comparable country on Earth, not because its finances are the most disciplined, but because the world has no choice but to hold its debt. The mechanism I just described shows up pretty clearly in the data. Roughly 60% of global foreign exchange reserves are held in dollars. Central banks around the world, when they decide where to keep their rainy day fund, predominantly choose US assets, not out of affection for the United States, but because the alternatives are less liquid, less stable, or simply smaller in scale. US government debt currently stands at around $33 trillion. By most conventional metrics, that should make investors nervous. It doesn't. In a crisis, demand for US treasuries typically increases. The size of the debt appears to be largely irrelevant to buyers. Because the dollar's role in global trade means there will be always someone who needs to hold it. The estimated borrowing advantage this gives the US is somewhere around 1% per year relative to what it would otherwise pay. On $33 trillion, that is a substantial number. It compounds. It doesn't go away. It is, as Valéry Giscard d'Estaing put it in 1965, an exorbitant privilege, and the French were not using the word as a compliment. If we go back to the Kuwaiti dinar, which we covered earlier in the video, it scores well on the first measure. it scores poorly on the other two. The US dollar is dominant across all three, and that dominance translates into concrete, measurable economic advantages: lower borrowing costs, persistent current account deficits, and a safe haven status that strengthens the currency precisely when you might expect it to weaken. So the next time someone tells you which currency is strongest, it's worth asking which definition they're using. The answer changes considerably depending on that choice.